Hello, YouTubers. It's Alaska Prepper here. It's time for your wake-up call. So I found this little gem here yesterday on Sunday while I was looking through some financial articles, and I thought you guys would be interested in hearing it. It's not that long of an article, so I'm going to go ahead and read it. Hopefully it doesn't take too long, and I might pause for effect here and there. But it's like I've been telling you guys, this article, I believe, is from the New York Times, and yes, it is from New York Times, and it's an op-ed. It's an op-ed that was written by Ben Bernanke, who was the former chairman of the Federal Reserve, the second to last, the one before Janet Yellen, by Mr. Geithner and Mr. Paulson, who are both former Treasury secretaries. Okay, so it says here what we need to fight the next financial crisis. And it's like I told you, it's becoming more mainstream that we are headed towards a financial crisis. Okay? Excuse me. So here we go. Congress has taken away some of the tools that were crucial to us during the 2008 panic. It's time to bring them back. And I wonder what those tools are. And as you can see here, this article is probably about 10 days old or so, roughly. And it says here, in September 2008, regulators faced the end of the Lehman Brothers and the beginning of a global financial crisis. And here we go. 10 years ago, the global economy teetered in the face of a classical financial panic, the most dangerous type of financial crises. In a financial panic, investors lose confidence in all forms of credit, retreating to the safest and most liquid assets, like treasury bills. Okay, here's one of my pauses. Retreating to the safest and most liquid assets, like treasury bills. You think that maybe there's a little thought shaping going on here? Okay. The prices of the risky assets collapse and new credit becomes available, with dire consequences for workers, homeowners, and savers. The seeds of the panic were sown over decades as the American financial system outgrew the protections against panics that were put in place after the Great Depression. Depression-era safeguards like deposit insurance were aimed at ensuring that the banking system remained stable. But by 2007, more than half of all credit flowed outside banks. Financial innovations like subprime mortgages and automated credit scoring helped millions to buy homes, but they also facilitated unwise risk-taking by lenders and investors. So this is saying that like financial innovations like subprime mortgages. In case any of you don't know what subprime mortgages are, they are mortgages that are given to borrowers who otherwise would be disqualified. Like for example, let's say someone who wants to borrow money to get a mortgage has a pretty bad credit score that under normal circumstances they would not get a loan. Get loans, and they're calling this financial innovations like subprime mortgages. Okay. Most dangerously, trillions of dollars of risky credit were financed by uninsured short-term funding. This made the financial system vulnerable to runs, not by ordinary bank depositors as in the 1930s, but by pension funds like life insurance companies and other investors. Or by pension funds, life insurance companies, and other investors. A balkanized and antiquated regulatory system made identifying these risks difficult and providing policymakers with limited authority to respond when the public erupted. The underlying performance of the broader economy before the crisis was troubling as well. Productivity growth was slowing, wages were stagnating, and the share of the Americans who were working was shrinking. That put pressure on family incomes even as inequality rose and upward social mobility declined. The desire to maintain relative living standards no doubt contributed to a surge in household borrowing before the crisis. And what they mean by here is the desire to maintain relative living standards no doubt contributed to a surge in household borrowing before the crisis. Right before the 2008 crisis, mortgages and refinancing was going nuts. I mean, people were refinancing their homes and taking out money out of their homes' um, equity so that they can either pay down bills or so that they can buy new stuff or renovate their homes, etc. Although we and other financial regulators did not foresee the crisis, and I would argue that they did not foresee the crisis, we moved aggressively to stop it. Acting in its traditional role as lender of last resort, the Federal Reserve provided massive quantities of short-term loans to financial institutions facing runs while cutting interest rates nearly to zero. And you do understand that the Federal Reserve being, I'm not reading right now, I'm just commenting on this. You guys do understand that the Federal Reserve, how can the Federal Reserve be a lender of last resort? The way that the Federal Reserve gets money is by it being printed out of thin air, okay? They don't have anything to lend. What they do is they print money out of thin air, okay, which diminishes the purchasing power of your dollars, and then they lend it out at interest. Whether the interest is high or low, it doesn't matter. They're doing is they're inflating the money supply and then lending it out to people they want to lend it out to. The Treasury Department stopped a run on money market funds by providing a backstop for investors. The Treasury also managed the takeover of the mortgage giants Fannie Mae and Freddie Mac, and worked with the Fed to try to prevent the collapse of large, systematically important financial firms. The Federal Deposit Insurance Corporation guaranteed bank debt and protected depositors. But the powers of the regulators alone proved inadequate. Congressional action made it possible for two presidents, one Republican and Democrat, working with regulators to prevent the collapse of the financial system and avoid another Great Depression. Most importantly, Congress provided capital to the banking system, allowing for the normalization of credit flows. Congress also provided support for housing and mortgage markets and authorized a powerful fiscal stimulus. The economy began to grow again in mid-2009, and the funds deployed by Congress were recovered with substantial profit to the taxpayer. Now here, they're saying that the funds recovered by Congress were recovered with substantial profit to the taxpayer. I don't understand what that means. I really don't understand what that means. How in the world did the taxpayer profit? Okay? Because anyone out there who lost a home during the 2008 financial crisis, did all those people get their houses back? No, I don't think they did. I don't think they got their houses back. I think that their houses still belong to the banks that foreclosed on them. Policymakers certainly didn't get everything right, but compared to most other countries, America's post-2008 recovery started sooner. Was completed faster, and was built on healthier foundations. Let's see. We are ready for the next. Are we ready for the next crisis? So here you go, ladies and gentlemen. This is what I'm telling you. They're putting this out in front of you. For those that want to pay attention, they're putting it out in front of you. Are we ready for the next crisis? In some respects, yes. Reforms of financial regulation have helped make the system more resilient, making a crisis less likely to occur. Banks and other financial institutions are financially stronger, and the gaps in regulatory oversight have largely been closed. Regulators are more attuned to system-wide risks. Our main concern is that these defenses will erode over time, and risk-taking will emerge in corners of the financial system that are less constrained by regulation. Even if a financial crisis is now less likely, one will occur eventually. To contain the damage, the Treasury and the financial regulators need adequate firefighting tools. After the crisis, Congress gave regulators some promising new authorities to help them manage the failure of an individual financial institution. Tools we did not have in the fall of 2008 when we faced the collapse of the investment bank Lehman Brothers. The so-called Orderly Liquidation Authority, for example, which was passed as part of the Dodd-Frank Act in 2010, could help regulators unwind a failing firm in a manner that could be less damaging to the system as a whole. But in its post-crisis reforms, Congress also took away some of the most powerful tools used by the FDIC, the Fed and the Treasury. Among these changes, the FDIC can no longer issue blanket guarantees of bank debt as it did in the crisis. So pretty much what they're saying is that the FDIC can no longer give banks a blank check. The Fed's emergency lending powers have been constrained, and the Treasury would not be able to repeat its guarantee of the money market funds. These powers were critical in stopping the 2008 panic. Now, ladies and gentlemen, let me give you my perspective on 2008. Okay, in 2008, I was ass asleep as a newborn baby. Okay, I knew absolutely nothing about what was going on. All I knew is that I was getting a paycheck 2 times a month, and it kept coming. That's all I knew. I knew nothing about what was going on. Okay. Am I glad that the banks and the system got bailed out in 2008? On a personal note, I have to say yes, because had they not been bailed out, my life would probably be completely different today than what it is, because I would have lost everything. All right, I would have probably lost everything had they not been bailed out. So I can't say on a personal note that I'm not glad that it did get bailed out. Was it right that they got bailed out? Was it right that private institutions got bailed out with taxpayer dollars? Absolutely not. Absolutely not. But in hindsight, knowing what I know now, I'm kind of glad that they did, personally, because my life would be completely different now if they had not bailed them out. And the same thing goes, I'm sure, for a lot of other people. However, it doesn't make it right that they did bail them out. I'm not saying that it's right that they did bail them out. And it gave us more time to prepare. Okay? From a political perspective, Congress's decision to limit these crisis-fighting tools was predictable. Many of the actions necessary to stem the crisis, including the provisions of loans and capital to financial institutions, were controversial and unpopular. Well, one of the things is, during that time, if you remember Ben Bernanke testifying in front of Congress, they asked him, so on top of the $700 billion that you used to bail out American institutions, you also printed in excess of, I think it was 13 trillion or 14 trillion dollars that was doled out to central banks all across the world. So on top of the 700 billion that they used to bail out American institutions here abroad, I mean here in the States, they printed in excess of 13 trillion dollars to hand out, just to hand out at 0% interest to central banks all over the world. Of course that's unpopular. That's why I say that we are great. The U.S. is great at deporting or exporting, not really deporting, but exporting inflation, because that's exactly what we did. To us, as the public, the responses often seem unjust, helping some of the very people and firms who had caused the damage. Those reactions are completely understandable, particularly since the economic pain from the panic was devastating for many. Yes, it was devastating for those that weren't involved in the corruption, because most of, if not all of the people that were involved in the actual corruption, they all did very well for themselves. The paradox of any financial crisis is that the policies necessary to stop it are always politically unpopular. But if that unpopularity delays or prevents a strong response, the cost to the economy becomes greater. We need to make sure that future generations of financial firefighters have the emergency powers they need to prevent the next fire from becoming a conflagration. And I had to look up the word conflagration. I didn't know what it meant, but conflagration is like a fire that keeps spreading and spreading and spreading. Okay? So they're pretty much asking for a blank check for the next financial crisis. That's pretty much what he's saying that this is the tool that is needed that they don't have. We must also resist calls to eliminate safeguards as the memory of the crisis fades. For those working to keep our financial system resilient, the enemy is forgetting. So the enemy, and you know what? This is true. The enemy is forgetting. So those of us that forget what happened, and those of us that forget what the price was that we had to pay for bailing out these private institutions that since have been caught in many, many, many scandals. I mean, Wells Fargo alone, how many fines have they paid in the last 10 years for doing things that were illegal? And how many of their people have gone to jail? No, what they do, ladies and gentlemen, is I took a little bit of high math in college, and they have what are called statisticians. And this is what a statistician does, or this is what I can see a statistician doing for one of these banks. They go, okay, if we do this, and whether or not it's illegal, if we do this, it will earn us $10 billion. However, the chances that we have to pay $1 billion or $2 billion in fines are very high. So the decision makers go, wait a minute, we're going to make $10 billion and we may have to pay $2 billion in fines? Absolutely, we're going to go ahead and do it. We're going to go ahead and do it and pay those fines because we're still making $8 billion that we would not make otherwise. That's how they look at these things. Okay, and it doesn't matter who gets hurt, all right? No one ever goes to jail because the system is made for these guys that make the money. Okay, it's like I forget his name, and I know that his name is on the tip of my tongue, but George Carlin. It's like George Carlin said, it's a big club and you ain't in it. Okay, this is a really big club, and guess what? These guys are in it. You and me, we are not in it. Okay, so, well, ladies and gentlemen, this is your wake-up call for today. All right. I try not to rant too much today. Okay, I'm trying to keep my ranting a little bit down. All right, that way you guys can start off the day well. All right. So, having said that, ladies and gentlemen, I hope you enjoyed this episode of your wake-up call. Have a great day. I will talk to you guys tomorrow. Hopefully, we will see what happens. And as always, remember to be good to each other. When good people do good things happen. Remember to reach one, teach one, and repeat. If we all did this, the world would be a better place, and you know that it will be a better place. And please remember to like, share, and if you're not subscribed, I don't know what you're waiting for. Subscribe, okay? And share this, all right? Share this. This may wake someone up, all right? It's been 10 years, all right? It's easy to forget things in 10 years, especially if you're living comfortable right now, okay? So many blessings to all of you and your families. This is Alaska Prepper, and I'm out.